U.S. inflation has cooled in recent months, leaving investors bracing for what's to come in 2023. Blackrock says a new investment playbook is needed and a recession is foretold. Blackrock Global Chief Investment Strategist Wei Li is joining us now. It's good to see you. Happy holidays to you.
Happy holidays.
Thanks. And so what is the playbook? What do investors really need to key in on going into 2023?
As we head into 2023, different from previous year ahead outlook, we're not positioning one set of investment views that are expected to work for the entirety of next year. We believe in an environment of higher macro volatility, of higher market volatility. A more nimble approach is warranted, which is also why a new playbook is warranted. So currently we're still risk off. We have been underweight developed market equities for quite a long time, for the most part of this year, and we have been overweight investment grade, so high grade credit. But at some point, we want to turn more positive. We believe that we would turn more positive, and this playbook points to us turning more positive. But in order to get there, we either want to have a higher risk budget to play with, which will be driven by macro indicators and market indicators, or we see the bad news being priced in fully in markets. So currently, as you said at the beginning, we forecast a recession in 2023. We also forecast earnings contraction. That is not being priced in by equity market, which is why we're currently underweight developed market equities.
What if I don't have kind of a high risk propensity and because my portfolio is on fumes after 2022, where then should I be placing my money?
Well, the difference versus beginning of this year, as we look at the beginning of next year, is that finally income is back in fixed income. So you're getting paid quite handsomely in the short end of the government bond market. You get paid more than 4% without taking duration or credit risk. And for high grade credit, you get paid more than 6% without taking much duration risk, but also, frankly, not much credit risk, which we think is very, very attractive, which is why in the latest outlook, we have pushed further our overweight of investment grade to +2 from +1 on a scale of -3 to +3. And we use local currency emerging markets where we have been overweight for parts of this year, but we downgrade that to neutral in order to fund this further upgrade in local, in high grade credit. So this is how we would kind of think about bunkering down as we navigate recession. And at some point, we want to turn more positive, and that would be either through greater risk budget or through markets pricing in more of the macro outlook that we see coming.
Your team writes in the outlook that equity valuations don't yet reflect the damage ahead. Well, what do you exactly see coming? And then if you do see more damage ahead, do you see new lows for this bear market happening next year?
Well, currently, if you look at S&P 500, it's shy of 3,900, and that prices in a peak rate slightly above 5%. And it also prices in a rate cut being quite aggressively baked in starting Q3 next year. At the same time, you work it backwards, it prices in earnings growth for next year at mid-single digits. So what do we agree with and what do we not agree with? We do agree with the fact that peak rate is likely going to hit a 5.25%. That is our forecast, but we do not see rate cut cycle starting next year. In fact, we see it starting in 2024, but even then it's more muted than what currently markets are pricing in. So that's one aspect of market pricing that we would lean against. And also we see US equity market in terms of EPS growth for next year at -6%. And that stands in contrast to the current consensus and market pricing, which is why we would lean against the equity rebound that we saw at various moments, even just this month. In terms of lower lows, but actually with S&P at 3,600, which was the summer lows, that would be ballpark reflecting this not deep recession that we see coming, and that would be an indication for us to want to turn a bit more positive if we get to that level.
So we've been talking mostly about the U.S., although you did mention developed markets versus others in the world. But I do wonder, when you look around the globe, is there any market that you think will be more resilient in the coming year, or that is sort of an overlooked investment possibility?
Well, at this juncture, we talked about asset classes, and currently we have a preference for credit over equities. But when we look at regional, global nuances, I would say currently we're underweight developed market equities, but we're actually neutral emerging market equities. And that is in part reflecting the fact that as we head into 2023, different from this year, China is going to reopen. China is reopening as we speak versus 2022, where China has been in lockdown for most part of this year. So that momentum is somewhat behind our current preference for emerging market versus developed market equities. And also, in addition to the China story, dollar, right? So far, what caught investors by surprise in 2022 is the ferocious strengthening of dollar momentum. And as we head into next year, the interest rate differential, it's there, but the gap is somewhat closing with the ECB, with the BOE also catching up really quite quickly. And at the same time, if you think about the broader environment around inflation is coming down next year. We do not see dollar strength persisting in 2023, and that would be somewhat supportive of emerging market as well. Now, I said supportive and I said preference for emerging market over developed market, but given our broadly risk-off stance, even our preference for emerging market equities is currently a neutral allocation in portfolios.
Right. Definitely not pounding the table on that one. Thank you so much, Wei Li, Blackrock Global Chief Investment Strategist. Thanks so much. It's been a pleasure to talk to you this year. We'll see you in 2023.
Looking forward to that.
Thanks.